So here we go. Today is just sort of the most recent example of our commitment to financial education. This is our fifth of 8 mindful money education sessions. We'll call this Mindful Money 105, Smart Borrowing, Understanding Loans and Lenders. December 10th, a little earlier in December, we're going to do 106, which is going to be how to pay off debt, and can and should you do it. And then in January, we're going to do 107. It's going to be how to read your credit profile. And then in February, we're going to talk about education, developing skill sets so you can earn more. The idea behind that is how do you earn more. Now, Paul, do you know, did we send out the workbook already today? We did? Yeah. Okay. Yeah. So hopefully everyone's got the workbook that's on. And oh yeah, and the survey that goes out afterwards, please do respond to that. Even if you see this in video after the fact, we're quite far along in the development of these different courses. And so it's kind of exciting to get information back, and we'll loop that. Now I think we're looping information in for sort of revisions of the courses that we have in design right now. With that, most people will probably borrow money at some point in their lives. This chapter here, we cover the ins and outs of loans and debt, types of debt, when debt might be considered good, when debt might be considered bad. Then we're going to talk about the basics of the loan calculation. We're going to cover risks and consequences of different kinds of loans. And finally, we're going to talk about the process of getting qualified for a loan. And Paul is going to kick us off with types of debt. Paul.
Jonathan. So as you probably know, I'm Paul Rubin. I'm a planner at Mindful Money, and I'm a certified financial planner. So the first topic we're going to get into is the types of debt that we have. So before we get into this topic about debt, I'm curious for those who've showed up today, and feel free to type this in the chat, who here has taken on debt or still has debt? And if so, please feel free to share what kind of debt as well. And I'll share for myself, I've taken on student loans. Yep, there you go. Student loans, and also I have a mortgage as well. I personally don't consider credit cards that I pay off every month, but
I've had credit cards I have not paid off every month. I mean, I was 19.
Yeah. What about business loan? Anybody have a business loan now?
We've done that.
Yeah. Cool. Well, thanks for sharing it, but that's great. So we've classified debt here into good and bad debt. We've done so based on the future value of the item that you're taking the debt out for. So for example, for a home loan, it's assumed that the value of the home goes up over time. So it's wise to take out debt for such an asset. Same goes for an investment, business, and education loans, because you're expecting to get some sort of return on it. Conversely, the debt and the bad debt section are usually for such items. So credit cards are typically used to purchase goods and services. Yes, you can get some benefits from the, building up your credit score and such, and getting points, but you're not looking to get some sort of return otherwise. As for car loans, car values only drop with the exception of vintage cars. So this classification doesn't take into account interest rates in terms of the loan. So it's not to say you shouldn't take out a car loan or not, but just saying that you're not actually expecting to get some sort of return on the investment. So let's go a little bit more into good debt. So as mentioned, this is the debt to help increase your assets, such as a home, building a business, or getting an education. So in doing so, you may even be able to generate revenue in the case of a business, or perhaps renting out a home. With an education, you're more likely to secure larger income. Again, this does not take into account the terms of debt. So interest rate and how long the term is not factored in, but generally speaking, you want to accrue debt when you can use the capital to get a great return on the investment that is better than the interest rate you'd be paying on the debt. So as we go a little bit more into bad debt, as mentioned, this is when you take on debt to purchase items that depreciate in value or just don't give you any sort of return. So for example, we commonly use credit cards, in some cases, personal loans and payday loans to pay for everyday goods and services. We don't typically use these to invest in an asset that produces a return on the investment that is better than interest you would accrue for these types of debt, because they tend to have higher interest rates, so you wouldn't want to use them. Furthermore, while you do purchase an asset with a car, as I mentioned, the value of it does not appreciate. So it doesn't really make sense from a return perspective why you'd want to take out a loan for a car.
As Paul mentioned, in good debt versus bad debt, and borrowing to buy things that add value over time could be a good idea. Borrowing to buy things that decline in value over time can be a bad idea. That's the general categories, but these aren't that clear cut. So there are good debts that can become bad debts that can be good. Like a home. I have these two examples. There's a home mortgage, just before a real estate collapse. We saw a lot of people suffer from that, from different kinds of debt that ended up haunting them in 2008, 2009, debt they took out in 2006, 2007, or student loan for a degree that you don't finish. I use those two examples specifically because I purchased my house in 2007. We were underwater probably for 6 years after that. And so you have to have the time and income to write it out. I also, my graduate program, this is, in these kinds of things, I've been a little bit open book about these, but my graduate program, I never finished. So all of my student loan debt came from my graduate program, and I dropped out to start working at Dean Witter. I never finished my thesis, never finished the master's program, and I walked out with, I think it was $45,000 or $50,000 of student loan debt. And that's the debt that was on the path to, thank you, Koala, big hugs, man. The path that was on the path I was on was to become an academic, which that debt would have been good for that. But I never got to finish, or didn't, I chose to leave for reasons. And so that, I end up with the debt and have to figure out another path. And there's bad debt becomes good debt. For example, you can spend some money on with a credit card to buy a wardrobe that enables a better job, or a car loan that enables you to get to work, or even using a credit card to earn points as long as you pay them off every month. So there is some debts that could be classified as bad debts that can be useful. So these are the general rules about debt, what's good and what's bad. But they aren't all obvious, and life has a tendency to surprise us. I thought I was going to finish the degree and get a PhD and become a Tibetan, Buddhist scholar and translator. That didn't happen. So, hit me out of left field. And it forced us to make choices. And the more debt you have, the fewer choices you have. And that's, in general, what you're trying to do, is avoid that being backed into a corner. So before we get into loan fundamentals, how many, you guys already listed this, but I want to see, has anyone borrowed for more reasons than I have? I have borrowed, I want to list this down. So I've had 9 different kinds of debt, and you don't have to list the debt again, but just the number of different kinds of debt you've had. I have credit cards, car loans, multiple mortgages, HELOC, personal lines, business lines, student loans. I did layaway when I was a child, when I was in high school. I put margin on stocks. I think that's the 9. No gambling.
With the sharks.
No gambling debt. Does anyone have more than 9? I don't know of anyone that's had more than 9. I'd love to hear it if someone has more than that. All right, Paul, you want to lease into loan fundamentals?
Yeah, and I can't say I can beat that. So what are the components of or terms of a loan payment? And there are 4 details you want to know. So first of all, there's the amount you borrow, or the principal. And then there's also how often you make the payments, how much you're charged to borrow, which is the interest, and then the total repayment period. So these are the important factors of what goes into an actual loan. We'll go into a bit more detail with these. So let's take a look. So the total amount you borrow is how much you'll need to pay back, which is better known as the principal balance. The principal balance is the amount that the lender uses along with the interest rate to determine how much they will earn from you over time. And this is called the interest. So you take the balance and multiply it by the interest rate to get the interest, or the amount you are charged to borrow the money. Well, and I'll show you an example, or we'll show you an example of what that looks like in a moment. The interest rate is determined by the level of risk the lender thinks you pose, which is based on your credit score, credit history, and the prevailing rates at the time. Like, for example, now mortgage rates are really low. So if you got a mortgage, you can likely, with a good credit score, get a good rate. The payment interval is how often you must make payments, which is typically monthly, quarterly, or annually. Sometimes they'll have it where, if you pay it a bigger chunk at a time, like annually, you might even get a discount. Lastly, the term is the amount of time you have to repay the loan. In some cases, you're able to pay the loan off sooner by applying larger payments. The more you stretch it out, the lower your payment is, but the more interest you pay over time. So you always want to kind of find that balance and figure out what you can afford and how much interest you're going to pay over time. So here's an example. that takes into account all the components of a loan. So in this example, the principal balance is borrowed is $1,000. The interest rate is 24%. And so this is the amount that you pay on the principal balance over the course of the year. So over the course of the year, 24% of interest accrued on the principal balance of $1,000, which generated $240 worth of interest that the borrower must now pay back with the principal. So now the initial amount of $1,000 owed is $1,240 because you add up the two.
So has anyone heard the quote, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And if you've heard the quote, can you tell me in the chat who said it? Well, who people say said it? It's a question.
Can you repeat it one more time?
Compound interest is the eighth wonder of the world. That you find quoted on, on like Facebook photos all the time. The second part is he who understands it earns it. He who doesn't pays it. Do you know who said the first part that's quoted always? It's a good guess. It's not Warren Buffett. Got to go back in time a little bit. He's a physicist, genius, not Abraham Einstein. There it is. Boom. Yeah. And there's some argument about whether or not he actually said it, but doesn't really matter. When we talk about investing, we talk about earning compound interest. The thing we want to avoid, one of the most debilitating things in personal finance, is debt that builds on itself. So if you pay partial interest on a debt and the principal grows, that forces higher interest payments in the future. So when a debt compounds, that means unpaid interest gets added into a principal, and future interest on the balance is higher because the balance is higher. So anyone has a credit card and they make minimum payments, or if you had one of these funky mortgages in 2006, 2007, that it didn't fully amortize, so some of the interest got tacked onto the mortgage at the end, and as your interest rate increased, it got more tacked on at the end. That's one of the things that got people into a lot of problems. This is kind of what it looks like. This is the same picture we had that Paul showed us. Interest rate's a little bit lower. And then you see in the second group here, the interest rate just gets added on to principal. And then the next period, you're paying the same interest rate, but it's on a larger principal amount. So that total interest payment is increasing. Now, if you do this for a period of time, you obviously are increasing on a regular basis, and it becomes what's the word for it? It's not straight line. It's not simple. It's compounding. There we go. The other side of this issue is paying all the interest and a little bit of principal every month. Now, every time you do this, you move ahead in your payment. That means the next month, when you pay the same payment, you're paying all the interest and a little bit more principal. Right? So each payment you make has a little bit lower percentage of interest, a little bit higher percentage of principal. Now if you can make even larger payments, then you shrink the life of the loan because you're hitting the principal earlier, faster. So this process is referred to as amortizing a loan. It's the slow process of paying down a mortgage or any time period loan you have. If you've got a 15-year loan, if you've got a car loan, these are all amortized loans.
Yep. So next topic we're going to cover is the risk of debt. So we talked about the different debts earlier, such as home loans, or all the 9 that Jonathan mentioned, but home loans, auto loans, and student loans. But now we're going to discuss the different risks associated with each type. So some of this was already covered, but here are the elements of debt. A borrower borrows money from a lender. There's a promise to pay the amount borrowed plus interest. Then not all debt is problematic, such as home and business loans in which you can repay the debt. Runaway debt, or debt that continues to accrue and you have no plan to pay back, can cause serious issues, leading potentially to seizing of assets, garnishment of wages, or even bankruptcy. But broadly speaking, there are 2 kinds of debt, secured and unsecured. And the difference being that one is tied to an asset, such as a home and a mortgage, and the other is not. And then the lender has no recourse, or less recourse. So with auto loans, the risks are that you could fall behind on payments. The lender could repossess the vehicle and then you're without a car. I remember when I was in high school, Lisa shows these videos of repo men and how they come and try to steal your car in the night, which I thought was pretty cool, but I didn't understand the context, and now I do. But luckily I was never the recipient of that. But anyway, depending on your circumstances, you could be subject to a high interest rate. And lastly, the car loses value over time. So if you wanted to sell the car and pay the loan off with the proceeds, that might be more difficult to accomplish. Whereas if it were to appreciate, then it'd be easier. So you can see some tips to avoid these risks here, such as repaying with cash, planning enough money before buying or buying used, or also choosing a shorter term loan so that you're not on the hook for a long time. So if you've taken out a student loan, I'm curious from people in the chat if you want to share it, did you have a process determining whether taking out the loan was a good investment in your future? In other words, did you think about how the investment might impact your earnings or future earnings when you were going to college or when you went to grad school? Did you know about them when you first got loans, Jonathan, or like when you were leaving, like when your exit plan thing?
No, I made sure the loans I took out all had options of non-payment or reduced payment without interest building.
Got it.
Which meant that I worked more because I couldn't take out other loans. Trade-off.
Well, so when I went to school, I thought I would be happiest pursuing what I wanted to without much foresight into how it would translate into future income. So I thought of like the best program, and I kind of just took the approach of like, I'll cross that bridge later. So I don't know if I recommend that, but I mean, I don't know, there's some value to like hearing your story, Jonathan, about like, you know, it didn't necessarily translate into like income, but it gave you life experience and you learned something about yourself. And so I think that's valuable. But so if you want to think strictly in terms of return on investment though, you do want to have more foresight about that, which I didn't have.
That's pretty much, that pretty much leaves you with engineering, like, you know, or something that's really science-based. Because if, you know, any of the humanities, which is what I was really, you know, ended up being interested in, there isn't really a path, you know, to a career path. Then you got to figure it out afterwards. And I knew that going in. But
I think the thing that I valued a lot from it was like a liberal arts education is what they call it, right? But like the idea to think critically about the world, which I think is invaluable. But yeah, it didn't necessarily, like you said, translate to income. If you want to like do that, you should probably just go to like one of those engineering boot camps, where they call them. So. Right. Cool. Anyway, the risks associated with student loans is that you may have transcripts withheld, lawsuits, wage garnishment, or long-term credit problems. Student loans can be a serious amount of debt, sometimes reaching into the hundreds of thousands of dollars. So this is especially if you're going to graduate school, law school, medical school, things like that. But the difficult problem with these types of loans is that it's tied to your potential to earn income, unlike how a mortgage is tied to a home. So you're kind of the asset, and you need to produce. So it's really on you as the buyer to generate the income needed to make the payments, which is, I think, pretty stressful. So before taking on student debt, it's important to estimate your return on investment, pursue scholarships and other forms of money relief, and perhaps get a part-time job in college and understand the terms of the loan before taking it on. Not everybody does that.
So how many of you borrowed from family and friends? And if you can put it in chat, what was it for? Like as people are thinking about it, I have a good friend from grad school. His name is Gary Ray, and he was the guy that when I was short, he'd loan me $20, and if he was short, I'd loan him $20. And over the years, you know, there've been a few others, but Gary and I created this habit of lending to each other for short-term issues all the time. It seemed to be every time that I was in, you know, every time I had a problem, or ran short one month, he was there to help, and every time he was short, you know, I could be in a position to help. So it's really interesting partnership, actually. Yeah, I think it's, you know, at first borrowing from a friend or relative can seem like a really good solution for a short-term issue, since it, you know, can involve low or no interest, it's flexible payment schedules, and, you know, they're going to be okay if you hedge a little bit. However, does everyone remember Polonius and his son Laertes? Neither a borrower nor a lender be. Can anyone finish that quote in the chat? Neither a borrower nor a lender be. Polonius's advice to his son Laertes. I hope someone can finish this. No? Okay. For loan oft loses both itself and friend. This is Shakespeare. I guess this is what you get for having a liberal arts education. So, you know, lending to family members often ends in hurt feelings. I've seen it time and time and time again. So, you know, there's holidays together are a pain. You lose contact with loved ones. Sometimes I've actually seen a family end up in lawsuits. and you see the movies, there's like physical altercations about this. The best advice I have on loaning to family and friends is don't do it. Second best advice I have, if you're going to do it, treat it like a gift that has the potential of being paid back, right? That's the best thing I can advise to do. Yeah, I think borrowing from your parents might be the Koala says he borrowed from his parents for the car. I think that might be the one thing that's acceptable. Like, because they're actually expecting to kind of help out, and they help you pay for school, they help you along the way. And I had a business that failed when I was like 22, and I had $10,000 of credit card debt, and my parents gave me, loaned me some money so that I could get out of that, and I paid them back. So.
And Jonathan, are you familiar with the applicable imputed interest rate of the IRS, that if you don't charge an interest rate to a family member, it's considered a gift?
Yeah, I'm familiar, and I know that doesn't get reported anywhere. So
yeah,
but Jennifer made a good point here. You can also have people sign promissory notes. That's how the first car I purchased, which by the way was a Honda Civic CRX. It was one of the most fun cars I ever drove. Only wrecked it 2 or 3 times, but that had a promissory, that had a co-signer. My parents were a co-signer on that one. So at first blush, home loans can seem like a low risk option with plenty of potential for positive results. Nevertheless, people owe trillions on mortgages to mortgage companies. It's a lot of money for one group to owe another group. So fixed rate, low interest mortgages can help renters become buyers. But as we learned in the Great Recession, complex mortgages and adjustable rate mortgages or interest-only mortgages can lead borrowers to serious financial trouble. So any home loan that might require monthly payments of more than 30% of your take-home salary might be a bad idea. One false move, and you could end up, owing penalties for late payments or facing credit issues, or so the best thing is to stick with low cost 15, 30-year fixed mortgages. And right now there's no reason to have a variable rate mortgage. Rates are so incredibly low. So that's the thing I'd leave you with on this is, if you haven't looked at refinancing at this point, if you have a debt on a car you can refinance, or debt on a house you can refinance, or a business you can refinance, or now is the time to really consider this seriously. So credit cards. Credit cards can be handy, but they're a problem. They make it way too easy to spend, and we tend to swipe our cards more often than we probably realize. If you get in the habit of every day you go out for lunch, you swipe it, you get coffee, you swipe it. If you're not paying attention, that can build up. So the issue there isn't that you have a lot of small debts that build up. It's that the interest rate on credit cards is usually atrocious, meaning you could end up paying triple. So your $4 cup of coffee could be $12 unless you pay it off at the end of the month. So best advice I have with credit cards, if you have trouble paying them off every month, don't use them. Use cash, use a debit card, don't carry it with you, restrict their use to specific purposes. Like, I'm gonna use my credit card for travel because I get travel insurance, and get into the habit of paying them off every single month. So here's the question: is debt putting you and your family at risk? And this is kind of how you figure that out. So totaling up your debt payments each month, including your housing payment, your car loans, student loans, minimum credit card payments. This is your monthly total debt expense. You divide this number by your monthly gross income, and this gives you your debt to income ratio. And just oftentimes you'll see us when we're presenting about the markets and economies, there is an aggregated debt to income ratio that's used as sort of an economic prognostication tool, and it's low right now because rates are so low, nationally. But individually, if your debt to income ratio is higher than this 36%, if it's below, you're okay. If it's above, you might want to take a look at that.
So we're going to talk about loan qualification next. And my experience, so when I was applying for a mortgage, it was right around the time I was taking my TFP coursework. So I was learning about, what's the percentage of income you want to have qualified so where it's comfortable. And I was getting pre-qualified, or my partner and I were getting pre-qualified for higher than what you should have, up to like, I think 36 or 38% of income, when it should be like around 27. It's like more conservative. But yeah, the process was very, like, a lot of paperwork. You had to show a lot of information, and it was kind of annoying. And then seeing the movie like The Big Short and hearing about what happened in the financial crisis, and just not trusting the lenders, to be honest, because they want to approve you for, whatever, because they want to get as much money and interest. So I didn't trust them, and I don't know. It was kind of a bad experience, to be honest. But I just imagine people who aren't as informed, they just get taken advantage of. But anyway, so going to the process of getting qualified, is that because the savings are too liquid and they think you might just spend it? It's possible. Do you have any insight into that, Jonathan? Is why assets aren't considered part of the loan qualification process? Or?
Well, so I guess there's multiple steps to this. The first is there are loans out there that will allow you to use assets as collateral. So you just have to find the right kind of borrower that does that, or the right kind of lender that does that. The second thing is those rules changed a lot after 2007, 2008, 2009. It used to be that they would basically take, you could just, they call them liar loans. You could just basically say, hey, I make this much money. There was no proof required. And you could have proof of assets. And it got so bad in 2007. I got a really close friend of mine who's a mortgage broker, so I get a lot of the inside scoop on this. And he said that he could basically get anyone qualified for anything without proof of any income or assets. And so because of that, banking regulators and then banks, to protect themselves, changed their tune. And in the last 2 or 3 years, and they locked everything down. You needed a proof of income, you needed a proof of assets, and they wouldn't accept proof of assets for probably until like 2-3 years ago. But we start seeing these proof of asset loans that are starting to pop up again. But they're, it is a greater risk to them, even if you have the asset, because those other assets, even if they're taken as collateral,
right,
they can go down in value, they can be misinvested, so it's still a greater risk for the lender. But if you've got $1 million, you're trying to borrow 50,000, that's kind of ridiculous that they don't allow it. It's just a matter of priority and how much risk protection do they need. But you can always find another lender.
But it's also risky that you could lose your job too. So I mean, to me, it's a little strange. But anyway.
True.
Anyway, but before you go out and attempt to get qualified for a loan, there are some important steps you should take. First, you'll want to know your credit score ahead of time in case you need to improve it. It's kind of pointless to go and try to get a loan if you don't have a good credit score and you need to build that up. But then you'll want to get pre-qualified with a lender for a loan. So if you're working with the broker will help you shop around to different lenders to get you the best terms possible. If you aren't working with the broker, then you'll be going directly to the different lenders to see what you get pre-qualified for. And then you can compare the terms of the loans. But we tend to recommend that you just use a broker. Before you accept and get approved, make sure to read the fine print of the terms so that you know what you're actually signing up for. So we talked about debt, but what is a loan? A loan is a subcategory of debt in that it comes from a financial institution and not from an individual person. So the amount can be as little as $1,000 and up to several $100,000, like in the case of a mortgage. So as mentioned earlier, secured loans are tied to assets or collateral, and unsecured loans are not. The former gives the lender recourse to capture the value in case that you default on the loan. So when you apply for a loan, you may get different options for the amount offered, term, and interest rate. This could also be negotiated, or you may be able to shop around with different institutions. So you want to get the best terms possible, and that's why using like a broker is the best option.
Every loan poses different kinds of risk, but almost all lenders will start the process by checking out your credit score. And your credit score is going to dictate your loan process, what kind of lenders you can use, what kinds of loans you can access, whether or not you can get pre-qualified, the terms and rates you have access to. And so oftentimes you want to check the 3 credit bureaus, and they're TransUnion, Equifax, and Experian. They're the ones that keep your score, but there's an easy way you can do this for free at NerdWallet or Credit Karma. You can do this once a year, and it doesn't affect your credit to get a soft check. Now, if your score is less than stellar, it makes a lot of sense to get the credit report and check for errors, and bring any outdated issues current. So from a little personal story, I don't remember the retailer, Brass Buckle. I don't know if you guys know that store. I think it was a Brass Buckle credit card when I was in high school. I worked for Brass Buckle, and so I had a Brass Buckle credit card, and I was in high school. I missed a payment, forgot about it entirely, and then I checked my credit, 15 years later, and I had this ding on my credit. I didn't know what it was, so I owed Brass Buckle $25 with 15 years of interest. The Midwest, exactly. So I had to pay them $50, but it was a really easy fix. So you can easily check your credit report and see if there's any errors on it, or see if anything, hey, it was really easy to fix this problem, and just do it. And then it can actually improve your credit score, give you access to better loans. So in some circumstances, you can get pre-qualified for a loan. This lets lenders know your creditworthiness before you actually apply. If you're shopping around for a loan, you want to ask for pre-qualification. If you actually apply for lots of loans, it can affect your credit score. So this pre-qualification is kind of a soft, it comes with a soft credit check, so it doesn't impact your credit score. So if a lender approves you, then they make you an offer. They give you a pre-qualification, they give you an offer, and then you proceed, then they do the hard credit check. And so you want to do it that way if you want to talk to lots of different lenders. Pre-qualification allows you to shop around without hurting your credit. This allows you to review loan terms, interest rates, payment amounts, and any fine print, so you can compare and contrast, find the best deal that fits your needs the best. And that's not always the lowest rate. It could be a 15-year versus 30-year. It could be 2% versus 3%. It could be, there's lots of different terms that you have to come to terms with. Okay, go ahead, Paul. You're next.
So once you know you can get a loan, explore other options other than taking out a loan. Perhaps you want to start a business and you want a partner who has capital to support the business, or perhaps you can sell an asset to use the money as capital. Another option is that you could take a balance transfer from a credit card if your credit card has the option of a 0% interest rate for a period of time, like a year. You'll just want to make sure that you pay this off if you do that. If you're getting a secured loan or one with collateral with a loan tied to an asset, you may be able to get a lower interest because it offers the lender more protection. Another option is to get a cosigner, like was mentioned in the chat earlier. While this could help with the burden of a loan, it could cause problems if the other person fails to pay their part of the payment. Now you're on the hook as well. So before accepting a loan, if you do go that route, please make sure to read the fine print. Look at the loan agreement and make sure you understand the terms. Look for red flags that might signal predatory lending practices. Typically, this won't be an issue when you're working with a reputable financial institution or lender, but some issues that you may see arise are that the lender has prepayment penalties or not clear about how interest rates are factored in. The former is important because it would be advantageous to pay back the loan faster if you choose to do so. On the other hand, there may be some favorable terms such as late payment forgiveness, which has no penalty, and the ability to choose your payment date. So once you've read over the terms and you're satisfied, you can accept the offer. The lender will want some information from you to ensure that you're a viable risk and for lending the loan, such as your ID, verification of address, and documentation of income. Usually they want, do you know how many years of income they want, or months, Jonathan?
It changes. I think the last time I borrowed it was 2 years of tax returns. But that's for like a mortgage, not for
it depends on how large of a loan, huh?
Yeah.
So the lender will run a credit check, like Jonathan said, like the hard one, and confirm your credit score. And then finally, you'll be granted access to the capital for the funds that you're applying for. That's when you secure the loan.
So these are the 5 C's. There's 5 things that lenders are going to check out about you to see if you qualify for this loan. They are your character, your history. Do you repay your debts? Do you keep a steady job? Do you work to increase your income? These kinds of things. Capacity. What are your credit ratios? Do you have enough income that's not already committed to other debt payments so that you can pay this new debt? They're going to see capital. Do you have the money for the down payment? Are you going to put some money down so you have a skin in the game? Collateral is actually really important. So it's really interesting from a planning perspective, getting into discussions about collateral with people, because I think that the easiest money that I have access to, if I'm going to invest in a business or invest in, is money that has collateral in my home. So when I started, it was DO Wealth Strategies that became DO Wealth Management that became Mindful Money. I actually did that by using the home equity line of credit on my house, and I survived on that for a little while. And I did that because it was really cheap money. I had easy access to it. I didn't have to do much for it. Banks were safe with it, so it was really cheap money. Most people I talk to go, I would never do that. I would never use my home as a collateral. I want to pay my home down. So much so, we had a client conversation over the weekend And this gentleman was, he said, I've got 50,000 left on my mortgage, but I have to get 70,000 to, do this, to do this other property thing. And I said, well, you could borrow on that property and that would be a 4% interest rate, or you could borrow on your house, it'd be a 2.5% interest rate. And he said, no, I don't want to borrow on my house. I want to borrow on the property because, I don't want to have any additional debt on my house. So it's really interesting how people, use some collateral one way, but it's sort of mental accounting with this kind of stuff. And then finally, conditions, what are the loan terms, the interest rates and other repayment terms. And this is how lenders evaluate you. It's also how you can evaluate lenders, those loan terms. You want to find the right terms for you. Go ahead.
You got a question in the chat, Jonathan?
It was a line of credit. So he wanted, it's interesting. You're talking about the gentleman who had the property and so.
No, I think he's asking about you. It was before you talked about that. So when you took out money for the business. Yeah.
Oh, my loan for the business. So it was a line of credit and it was because I didn't have any clients and I had expenses. My wife and I had purchased a home and then I left Wall Street firms to start my own company. And so we lived off of debt for the first couple of years of that.
I guess I'm asking, was it a line of credit as opposed to a mortgage, and why did you choose that? Does that make sense?
I already had a mortgage and I couldn't. So it's also mental accounting. So in my own relationship, borrowing more on your first mortgage lumps in an expense that's not the house with the house. Mm-hmm. So that's verboten. We're not allowed to do that. So if I have a separate debt, even though I can use it on the house, that's acceptable. But then I have to focus on paying that debt off. It's the deal we make with our spouse.
Seems like it was a solid bet.
It was, well, at the time we had no idea. Looking back, it looks like a solid bet.
And when you say the risk with the home equity line is that it's subject to change, like variable rates, like after a certain amount of time period, whereas you can get a fixed rate loan with the mortgage.
Right. Yeah. So it makes a lot more sense if you have a chance to finance it at a low rate, to finance, I sort of don't want to say something like this, but if rates are like they are today and you can get, $200,000 extra dollars at 2.5%, it's free money. I mean,
I guess that's part of why I'm asking is because I've considered this, and most of my situation and also the startup, and so to take out, say, 150 or 200 with these interest rates, why not now?
So I would say, so I do know your situation a little bit, and this isn't specific.
Not advice, not asking advice.
Yeah. Right.
Hypothetically.
So I think the one thing I would never do, I would never borrow on my house at a low interest rate to invest in the stock market. Mm-hmm. That's crazy. Mm-hmm. That's a risk we can't anticipate, we can't figure out. But I've advised clients to borrow on their house and to finish their master's their MBA program. I've advised clients to, because if you're going nights and you're not seeing your kids and you could just finish it up in 1 year instead of having to take 3 years, that makes a ton of sense. Your income is up sooner. Same with a business. If you're starting a business and it's your own deal, yes, it could fail. You understand that risk.
Right.
But this is the kind of, you won't get this opportunity for capital again in your lifetime.
Right. Yeah.
I mean, this one, it may stay here for a while, but it's not coming around again after this is gone.
We'll see how this election turns out, and then we'll reassess.
And one last benefit I'll add is that pre-Trump tax law, you could deduct up to $1 million on your mortgage and $100,000 on a HELOC. Now it's up to, or that's for married filing jointly, and then it's half for single. And then now it's been cut in half, so it's $500 for married filing jointly, $250 if you're single in terms of interest deduction, and then for the HELOC, you have to prove that it was going towards home repair. So getting it for that graduate school or whatever, I don't know. You'd have to somehow show how you're improving the home with that. But anyway. So
you have to prove, but no one checks.
Right.
This is now recorded and it's online. I realize that. You have to attest that you used it somehow for your house.
Yeah.
That's your responsibility. Yeah.
But there's that added benefit of the interest deduction. So anyway.
You can go to the next slide. I think we covered this one.
Yeah.
So it's likely that you're going to take out a loan sometime in your life. In fact, most of us on this call already have. So understanding that step-by-step process of borrowing money can help you save money and also avoid some anxiety. You've got to remember that the pre-qualification steps are designed to help you evaluate the right loans and get the right terms without harming your credit. So always, if you can, get pre-qualified for some things, and look for those loans that have the right terms for you. And again, it may not always be the lowest possible rate. I'm going through this myself, where I'm trying to refinance my house, and I think I said this last month. I've been waiting for 2% with no points. I don't think I'm going to get 2% with no points. I really thought I was, and I was really waiting and holding on for it. I can get 2.25 with no points. I'm still waiting, but we're bordering on greedy and stupid now. I should probably just refinance with no points at 2.25 and call it good. So look for the loans with the right terms for you. Don't game it too much. And with that, I think we're at the last slide. Is that right, Paul?
Yeah. And would you say the threshold of when you want to consider refinancing about a 1% gap or difference between your current mortgage or loan and then refinancing? Or does it really matter, or you don't really know?
I think it depends on the greater situation. I mean, 1%, it may be a good
Starting point. Yeah.
starting point to think about it. But then what are you going to use it for? Is it worth additional, I don't know. I think it's just ridiculously low right now. If you have a 3% or a 4% right now, I mean, it's a total no-brainer to refinance right now. This is as free an opportunity as you will ever see in finance.
Can't you just wait when you refinance it to 2.25, and then like 10 years down the line, it's like up to 6% or 7%? You're gonna be like, yes.
Exactly. But I mean, I don't think anyone's calling 6 or 7% in 10 years. But if it's 4% and you're at 2.25, I mean, what? I mean, it's ridiculous. So I'd love to entertain any questions that anyone else has, any of the prior stuff or about anything at all. I'm willing to entertain. I'm not going to dance or sing, but I'm willing to entertain questions.
It's riveting stuff, taking copious notes over here. I've got a long list of debts I've had over the years too. I don't know that they're that exciting.
Sometimes you got to do what you got to do. I desperately needed a car, and 1982, put in the application with the car guy, said I get you a great rate at this bank, came back, declined, went to another bank, and this was 1982. The interest rate on the car was probably like 16%. But that didn't matter to me. I needed a car. So you just do it.
I think there's a lot of value in, so Scott just talked about his debts. I've mentioned all my debts. John just talked about taking out a 16% mortgage. I think there's a lot of value in recognizing that people that spend time in finance, we borrow. And I left the degree program with $40,000 in debt. I've blown it a number of times, and you just, you pick yourself up and you figure it out after.
I've noticed in my borrowing habits that I go through cycles where I'll just be like, I need to do this. I'm doing this. And then sometimes it works out great. And then sometimes I spend the next 2 or 3 years working my ass off to repay that debt, or just like grinding. And so, I mean, going back to the mortgage rates right now, in terms of refinancing plus pulling out money, if you have like a project in mind for your house, we want to put on solar panels. That's been something we've been thinking about for a few years now. And like if we get the new hybrid, okay, now all of our gas costs are going to be from the roof, essentially fuel costs, right? And so great excuses like that. In terms of like pulling out another, call it 35, 40, 50 to cover that array, any reason not to do that? I mean, at these rates, it's sort of like,
well, there's definitely reasons not to do it. I mean, there's definitely reasons not to do more debt's not a positive, so I think frugality still is the number one virtue.
Sure. Assuming we're still going to be coming in under our income ratios and not putting any sort of month to month at risk.
Right. Yeah. And I think that probably if you refinance, so you got to remember when you refinance, you may get a lower rate, but you're going to extend the time
You're
period.
pushing out the payback. Yeah.
Right. So if you can refinance to a lower rate and retain the time frame, so refinance to a 15 or a 20,
Mm-hmm.
you know, if you had a 30 and you're 8 years into the 30, you could actually refinance today in a 20, so cut off 2 years
Mm-hmm.
and reduce the rate and probably reduce your payment. That's that difference today, the 8 years ago, is big enough to get the benefits across the board, like
Right.
less interest payments, longer or shorter period of loan. So I mean, that's really what I'm looking for. But it's still, at the same time, I know that you're investing in your business, and I know you want to put on solar panels, and I know that. So I think that there are reasons to use the house, as I just would never go overboard, because it's
Right.
the house. Like
Yeah.
that's your. You want to get a divorce? Yeah.
You want to keep the house. Yeah.
What would you say from like a pure financial standpoint, stretching out as long as possible and getting a lower payments because the opportunity cost is the best avenue? I mean, assuming you capitalize on the opportunity cost.
So if you have a, if it's,
and it also, sorry, interrupt. So it also gives you flexibility and liquidity and all that kind of good stuff too. Yeah.
right.
Go ahead. Sorry.
I was just gonna say, if with loan rates where they are today, and you still got to use capital in a smart way, but with loan rates they are today, they're well below long-term inflation rates.
Right.
So when I say this is free money, that's what I mean.
Yeah.
So if you can't just get it, you can't borrow a bunch of money and take a vacation, because that's bad debt.
Right.
But doing something that's positive, that accrues value, you know, something in the house that adds value, the business investment that adds value, those kinds of things make all the sense with this kind of debt.
Yeah.
I mean, when you think about our federal government, this is when you do an infrastructure project, when you can do a 100-year loan for 2.5%. This is when you do that.